Hello, everyone. How are you? It's January 1st. Happy New Year. This is Advanced Accounting, Accounting 4030. And this course is being taught online. It's a 100% online course. And you have to organize your time and to study. This is not an easy course. Advanced accounting, from the word advanced, means that we are going to learn about complex accounting transactions. And the majority of this course is going to focus on business combination. What happens when a company buys stocks in another company? How to account for that? So business combinations and consolidations. All right, so chapter 1. Let's start with chapter 1. The reason I am doing this recording today directly from the textbook, because I want to show you the effective way of studying. One is you need to open your ebook. And two is you need to have an Excel sheet open so you can practice. I usually, with the snipping tool, cut a question or an example from the book and paste it to Excel, and then I start solving the problem. I will read the example and the solution from the text, and then I do it myself. And I add my own notes, I do my own highlights, I do my own arrows, etc. Another way is that, I'm not sure if I shared, sorry, let me just make sure I've shared the Excel file with you. I don't even know if I shared. Yes, so I shared the book. This is the Excel. So in Excel, I, for example, cut using, you can't copy from your book and paste, but you can use the snipping tool to copy or cut and paste. And then I read the solution and I solve it myself. I leave notes, and these are the arrows. I highlight, certain entries in a color and the entries that are different in another color. You should have, decide on a way of studying. Another way is that you use the old-fashioned way, paper and pencil, which is okay. Now, another thing that I do is Word. I use Word a lot while studying because I like to type in my notes. All right. So you really have to study. And some of you have a busy semester because you guys are doing your internship, but you still need to study and put time in studying advanced accounting. All right, so back to the textbook. And what are we going to learn about in chapter 1? So, companies, a lot of companies have a lot of cash that is idle, and it's a good investment if they purchase stocks in another company. and usually they buy common stocks. So when company A purchases stocks in company B, company A is the investor. Company B is the investee. Now, company A starts buying stocks and more stocks and more stocks. Yes? And the more the investor is buying in the investee, the more control or influence the investor has over the investee. All right? So why would a company purchase stocks in another company? There's several reasons, okay? But it can be to expand, to purchase a competitor, for example, or maybe a local and US company will purchase another company overseas so they can gain international presence. So there are several reasons why. But how do we account for that? There are a couple of percentages that you need to memorize. Below 20%, okay, which means I buy stocks, company A, the investor, buy stocks in company B, and I own less than 20% in the investee in company B. And then there is 20 to 50%. So this is the second group. Company A, purchased common stocks in company B, and now I own 20 to 50% of company B's common stocks, or I own 20 to 50% of company B. And then I kept purchasing, and now I own 51, okay, or more than 50%. So there is the fair value method and the equity method and the consolidation method that we are going to learn about in this course. That is like the most important topics that we need to learn. So if we own less than 20% in another company, we will use the fair value method. And this is a very simple method. You've learned about this method in your intermediate accounting, also in the financial accounting 1050. And that's what we used to call marketable securities, investing in another company's common stocks. When we purchase these stocks, again, I'm now focusing on ownership that is less than 20% in an investee. When I buy stocks, I usually pay the fair market value. So I will debit the marketable securities and I'll credit cash. Then I watch the stock value going up or getting down. Yes? And according to GAAP, we always have to value our marketable securities at fair market value. That's why this method is called the fair value method. If the stocks go up, I will increase my investment. If the stocks go down, I will decrease my investment. And if the company, the investee, pays me dividends, that will be a dividend revenue, considered a dividend revenue. That is the fair value method. Okay? It's straightforward and it is simple. But what if I own between 20 to 50%? Then we say here that the investor can exercise or may exercise influence over the investee. Okay? the investor may be able to exercise influence over the investee. And here we use the equity method. All right? Consolidation, in the future chapters we learn about it. Again, this is when we have control over the investee. And control is gained when we own more than 50% of the investee company. All right? The cost method, we use it if we have no way to determine the fair value of the stocks that we purchased, we can use the cost method. And here is how I study, I highlight major things that are important for me. So let's read this. Investor possesses only a small percentage of an investee company's outstanding stocks, perhaps only few shares, as long as it's under 20%. The investor cannot expect to significantly affect the investee's operations or decision-making. This is like many of us, small investors, like I may own 100 shares in Microsoft. I will account for that using the fair value method. I can't decide on electing board members. I can't change companies, IBM's policies, nothing, because I don't have any influence. All right? These shares are bought in anticipation of cash dividends and appreciation of stock market share. The reason I purchased these shares is because I want to receive dividends on a regular basis, and I want to sell these shares when their value go up, hopefully. Such investments are recorded at cost, which means when you buy it, you are going to debit the stocks or the marketable securities at the purchase price, okay? That's the cost, which is really the today's trading value or fair value of the stock. And then periodically adjust to fair value, okay? When the stocks go up, bring that investment up. When the stock goes down, bring the investment down. When you receive dividends, it's a dividend revenue, okay? So what are the accounting transactions here? One is the initial investment. That's when you credit cash and you debit the investment. Then the second one is changes in fair values of the equity security during the reporting period. Stocks go up, you increase the investment. Stocks go down, you decrease the investment. And the credit or debit, usually unrealized holding loss or unrealized holding gain. So if the stocks went up in value, I will debit the investment, but I credit unrealized holding gain. It's not a real gain because I did not sell the stocks. I'm just changing the value because GAAP tells me to report these stocks at fair value. And if the stocks go down in value, there is a loss. It's called unrealized holding loss, and I will credit to reduce the value of the investment. Investment is an asset. You increase it by debiting it, you decrease it by crediting it. Okay, and dividends, when declared, you are going to recognize them as income, as a revenue. Okay, I'm not going to talk a lot about the cost method, but I said that it's in the absence of the fair value, you can use the cost. I'm not going, okay, briefly, let's talk about consolidation because this is covered in detail in chapter 2, 3, 4, and 5. But in financial accounting, such control may be achieved when a stockholder accumulates more than 50%, okay? So many corporate investors acquire enough shares to gain control over the investee. When the investor purchases more than 50%. Okay? So now we are not just influencing the decision, we can actually make the decisions. The investor can direct the entire decision-making process because we own more than 50%. We can make the decision. All right? investors' control over an investee presents a special accounting challenge. Yes, consolidating journal entries are challenging. And we are going to learn how to prepare, how to combine the financial statements together when there is more than 50% ownership to have one set of financial statements. All right? The equity method. This is the focus of this chapter. So, in many investments, although control is not achieved, less than 51, okay? But there is an influence, and it's noticeable. There is a degree of influence. The investor has the ability to exercise significant influence over the investee. If an investor holds between 20 to 50% of the voting stocks of the investee, significant influence is normally assumed, and we are going to use the equity method. And this is FASB ASC Accounting Standard Codification Topic 323. You learned how to look up these ASC in Intermediate Accounting 1. You should go and read about ASC 2023. Okay. So ASC 323 basically says that when an investor owns between 20 to 50% in an investee in another company, the common stocks of another company, the investor should use the equity method to account for this investment. So when the investee, okay, that's the company that we acquired its shares, recognizes income, what should the investor do? When the investee recognizes loss, what should the investor do? When the investee does declare dividends, what should the investor do? Okay, there is no valuation here to fair value like we did in the fair value method. Okay, so there are a couple of transactions, and these transactions are investee has income, reported net income, or net loss, investee paying dividends. All right. All right, so what factors indicate when the equity method should be used? Again, when the investor owns between 20 to 50%, but there are other factors other than this rate. This is simple, okay? Like if we can find this rate, this is very simple, but sometimes there are other signs that we can see that will tell us that the investor has the ability to exercise some influence. So let's read this together. A term such as the ability to exercise significant influence is nebulous and subject to a variety of judgment and interpretations in practice. At what point does the acquisition of one additional share of stock give an owner the ability to exercise significant influence? This decision becomes more difficult in that only the ability, okay, the ability to exercise significant influence is needed to be present to use the equity method. All right? So, FASB, Accounting Standard Codification 323, you have to like memorize this 323, provides a guidance to the accountant by listing several conditions. So FASB tells the accountant and the auditor that if you notice the investor representation on the board of trustee is like noticeable, if there is a member on the board that represents an investor, that means that the investor has the ability to exercise significant influence. If you notice that the investor can participate in policy-making process of the investee, it means that the investor can exercise or has the ability to exercise influence. So in the absence of the ratio 20-50, any of these points here or indicators mean that the investor can exercise or may have the investor has the ability to exercise significant influence. Material intra-equity transactions between the investor and the investee. Okay? Again, if we're not sure, if we feel that the investor may not have the ability to exercise significant influence, then we are not going to use the equity method. All right? Here, if we feel that an entity can exercise control, not just significant influence, regardless of the ownership level, then consolidation is the most appropriate method of accounting. Okay. So this is a summary of the fair value method, the equity method, and the consolidation method. If the company, the investor owns less than 20% in an investee, we will use the fair value method. If the investor owns between 20 to 50%, we say that the investor or the investor may have the ability to exercise significant influence. We will use the equity method. And if the investor owns more than 50% of the stocks, of the common stocks, then we say that they have control over the investee through voting, and we will use the consolidation method. Okay? Then the equity method, in addition to that first journal entry when we buy the stocks, we said that if the investee recognizes income, the investor is going to recognize also income. And that is according to the share 20%, 40, 30, 50, definitely not 51 because it's between 20 to 50. And if the investee declares or declared dividends, then the investor is going to reduce their investment account by the amount of dividends. Notice that this is not a dividend revenue for the investor under the equity method. All right. And then I copied this question using the snipping tool, and I copied and pasted to Excel. And I read the example here. You can do again this, like I said, paper and pencil. And I solved it myself. And that's what you should do to master this. This is what you should do to learn. You can't expect learning, by just watching a video or learning is a long process, is a painful process, but you have to go through it. and you have to find your way. You have to find what suits you the best. And I'll be using the textbook. I'll sometimes use the PowerPoints, and sometimes I'll just copy and paste a question from your homework in Excel to explain an idea for you. If you have any questions while reading, you should email me. You shouldn't wait till last minute. You should email me Tuesday or Wednesday so I can get back to you. And you should be proactive and read and do everything in advance. All right? I'll prepare another recording, but let's stop here for now. Hopefully you guys read what I just shared with you, and then follow with the example that I will share with you in another recording.